All right, welcome to this episode. I'm your host, Xiao, principal on the venture investing team here at Mark 49. So today, our guest is Anthony Herman, who is also a principal on the team. Welcome, Anthony.
Hi, Shao. Thanks for having me.
Yeah, so you definitely have many different kinds of experiences here as an investor, as a as a founder. So tell us about yourself. Let's actually start with the intros.
Okay, yeah. My background, simply speaking, just I was a venture capital investor in the Bay Area, and I had a great opportunity to found my own company. And so I met some great folks, and we grew the company a bit, and I exited. And after selling my company, I joined Amazon Web Services in Europe, in Sweden. And that was in 2017, a period of high growth, especially amongst the venture capital and startup ecosystem for AWS in Europe. And that was a great experience and great opportunity for me to learn um, about the particulars of the European innovation ecosystem, but also how a huge company like Amazon functions on a global scale. So after that, I have started advising corporate clients on innovation investment. I've worked with various different corporate VC teams and innovation investment teams in corp dev under corp dev teams, and now I'm here with Mach 49, doing this on a much larger scale with much smarter colleagues than I am. I'm very happy to be working with you.
Well, that's lots of pressure for me to hear, right? So I'm not sure about being smarter than you. So definitely, enjoying having you here. You've tried every angle of the, innovation ecosystem, right? So from all side of the table, right? So now, let's actually focus on, the CVC side today for this call or this podcast episode, right? So one of the things, as any investors is they're doing here is deal sourcing. And then, whenever we talk about deal sourcing, you talk about the traditional channels, introductions, sometimes in cold email, others you go to events. What's your secret sauce for CVCs, to source deals other than the traditional channels, right?
Yeah. For a venture capital investor, whether you are at a private standalone fund, a typical VC fund, or inside a corporation as part of the CVC team, or any variations of it, I think it's true that venture investing is an art and a science. But the science part, I think it's fairly defined. It's fairly well defined, and it's not a large portion, I think, of a venture capitalist's job. The larger portion of it is the art portion of it, which is really, I think, centers on cultivating relationships. I think that the greatest value that a venture capital investor can extract from his or her daily work in this space is to get out there and cultivate the relationships that they have, speak to founders and other investors to understand really what's going on and level up their understanding of the various industry verticals and sectors that they are investing into by going out there and speaking to folks. So the primary way, it remains the best way to source deals is to speak to as many people as possible. From there, I think it's a matter of identifying, number one, the best people, the best experts. I think anybody in any investing role, if you've spoken to folks, other investors, or especially other startups and people in the ecosystem, names start coming up of folks who are particularly brilliant or smart or working on very interesting problems. And those are the folks that I think the best investors gravitate towards. And anybody with any intent and desire to source deals, especially source good deals, should be aware of that and be drawn also to good people in that ecosystem, whether they are developers or other investors. And from there, you'll inevitably hear about companies that are made up of good team members, working on problems that are very big and important, and have the potential to be a big potential return on investment.
Yeah, absolutely. Good points there, right? So it all comes down to the art side, as you said. It's a people business. It's actually, your network, which takes time for anyone to grow. And I actually personally think it's also true there, especially in on early stage firms, right? So how do you know there's this seed stage company versus like a Series C company, right? So the earlier stage you're actually looking at, I guess like all stages. Don't get me wrong, networking is important, but then especially for the early stage, things are less certain there, right? Definitely your relationship or, word of mouth or whatever we call that, it plays a huge role there, right?
Yeah,
So
absolutely.
yeah, absolutely, right? So now let's actually go to the next step. And once you have a deal, right? So you're looking at, this company, you're evaluating this company. I'm curious to hear actually this question. There's two folds, right? So what lens do you put on? I mean, we know that the tradition of the team is etc. What's your secret sauce? And also, would you put on a different set of lens, when you are a VC versus a CVC, I guess?
Yeah. Um, I'll answer this question kind of backwards from the order that you've asked it. First of all, I don't think there's much difference in the factors that should be focused on in determining a good investable company, startup, between a VC and a CVC. I think perhaps really the only different layer is that top layer where CVCs, of course, no matter the structure, whether you're very strategically tied to the parent company or even if you are a functionally or in form a standalone independent CVC with various LPs, you will still have to consider that strategic alignment of what you're doing and the companies that you're investing into if you are a CVC versus a VC firm where perhaps that sort of strategic alignment pressure isn't there as much. If you've defined the lanes and the verticals and the sectors that you like to invest in as a private standalone VC, really then your job is to just find the best team, best company, and make your bet on that winning horse. Now, beyond that, the factors that I look at, I think for both teams should be the same. For me personally, there's a clearly defined sort of order of operations that I go through. So I'll speak about this from the CVC standpoint. So number one, the first factor should be this assessment of kind of subject matter or vertical alignment, strategic alignment, and relevance to the large corporate company. Obviously, there's when you're working with the most innovative companies, in name or by the title or whatever's introduced initially, you might find some keywords that you think are relevant, but upon a deeper analysis, maybe it is or it isn't. And so beyond that step, I think everything kind of aligns, which is, number one, I like to see if, especially if there's new technologies being developed, exactly how robust and unique and different it is, or how disruptive it could be in the particular vertical in which the technology could be applied. I think that's step number one. Number two for me is definitely team. That's above all the most important factor outside of the actual product that obviously they want to sell, because the different experiences and what the team members bring to the table for this company, I think, is the win or lose deciding factor in almost all cases. And of course, in that particular kind of on that particular level of assessing teams, there's different arrays of desirability. If you are a repeat founder with very deep experience in just this very specific subject matter that is very applicable to large players and could be quite disruptive in a space, that's an obvious, you should bet on this company, even if perhaps the technology is not ready yet, because that team and the leaders have that track record, versus perhaps a team with a background that's not quite fit for what they're doing. And that's perhaps a team that you should do a little bit deeper diligence on and have a measured approach in trying to ascertain the future kind of potential growth of this company. After that, I'd like to see traction, and not just like product development traction. If there are some commercial traction, that would be great. The most recent cohort at Y Combinator, I believe something like 90% of the companies had paying customers when they graduated from the three month course. of that cohort. I think that the general kind of shift in the market now is going towards that, where liquidity for LPs is short. The VCs aren't fundraising as crazy as they used to because capital is tight, and now the LPs, the VCs bosses, want to see some actual kind of return, possible return on this capital, that would happen from this startup investments. And so really the measure of that is commercial traction, even if it is not a huge book of recurring annual revenue. Do you have some partners or some customers there that are paying today to pilot your products, or further along after that? After that would be a moat. I want to see clearly defined differentiated moat that makes this company unapproachable. And then I would like to see the partners in that ecosystem, other co-developers, especially other investors on the cap table, who could help and pitch into the growth of this company.
Yeah, well, thank you. That's very insightful, right? So now let's actually go through the process we have with all this, this aspects you're looking at, and then you actually check all the boxes, right? So which is rare, but it happens, as you know, right? And then oftentimes a company like that, it's already subscribed, right? So how do you, let's say, as you're leading the CVC team here, how do you actually win that deal opportunity to get in, right? So now actually flipping around the card, now it's for you to get in. What would you say?
Yeah, that's right. This is a very great question. And this is something that I think all investors should consider a little bit deeper than I think usually happens, right? Because I think the de facto kind of reply to this question, at least in my circles and from what I know, is, it kind of goes back to the basics. Human beings are human beings. And ultimately, you want to work with and be with people you like. And so, the investors that really invest the time to cultivate the relationship with those founders, at the end of the day, perhaps they get put in a little bit in front of the line in preference versus everybody else. But I think there's another level to this where I think CVCs can be especially more competitive and be differentiated in a crowded round, which is that, if you are a standalone VC, really, what are you providing to this company? I mean, three things, presumably. One is capital, second is your network, and third is your advice, your experiences, your knowledge, right? That's largely it for private VCs, right? You take a Sequoia and an Andreessen, any fund out there, that's primarily, those are the three things that you're providing. And so those funds will highlight that. I know so-and-so, I know Mark Zuckerberg, and I spent 30 years in this space. I can tell you everything, and we've got cash. Okay, well, everybody's going to talk about that. CVCs, though, have that and an extra thing that none of these private standalone, VCs can offer, which is an actual viable kind of a business unit with which that startup can grow. And so I think this is a very important element that more CVCs should highlight and should cultivate internally to be a value proposition to startups, which is, I am one of the largest car companies in the world, and you are an EV technology, startup. With your technology, I can apply it exactly to this business unit who's going to sell X amount of vehicles in this geographic space, and that's going to return this sort of actual business growth to you. Now, that is a very specific sort of offer that what private VC firm can offer in that way, right? Now, of course, always the difference here is, can you deliver or not? And there are many, many stories out there of CVC teams and CVC money not really, materializing into those meaningful commercial co-development, co-sale opportunities. And so that's the second factor, I think, of differentiating a good CVC and a not so good CVC is, can you deliver on that? And to deliver so, I would advise CVC teams to invest in creating this sort of portfolio growth team. Make sure you have internal experts who can expertly navigate your company, who is focused on cultivating relationships with key stakeholders inside your company, and can actualize these business partnerships and sales partnerships with startups with particular business units inside your company. And if you can build a track record of actually delivering on those promises, I can see many CVCs beating out the big names in private VC firms.
Yeah, thank you. So I was gonna say that the mothership support it's definitely one of the maybe arguably the biggest differentiator any CVC can bring to a table comparing to VC, folks there. But as you mentioned, there is not always happening, and there's also it's a very nuanced situation. It also kind of depends on the nature of the mothership business and the status, etc. Right? But then I was going to ask you the next question. You kind of addressed that, right? So now you have the deal. You invested in this portfolio company. How do you help this company grow? And you mentioned about using our terms here called CVBD, right? So corporate venture capital business development. That person there being the liaison. We've seen many successful CVCs having that role there, and that person usually comes from one of business units there, been there for a while, knowing the ins and outs of any set of BUs there. But other than that, any advice you would give to CVCs that are actually managing their portfolio companies there?
Yeah, um, I'll address this question in two parts. One is, it's important, again, harking back to my previous answer here, it's important to do the front end work, I think. A lot of CVCs, they're hyper focused on what they're doing, which is, setting up their CVC team, the investment deal sourcing process, investment analysis process. They're fighting every day to secure, funding, if there are CVC teams just investing directly from the balance sheet, that's quite limiting. And so there's all these very difficult things that CVCs themselves have to do just to set up this investing team. But I think the front end work should also include this focused investment of time and resources into developing this internal growth, portfolio growth, follow-up capability. Identify those key people who have been at that company for a while and can utilize their relationships to actualize these promises or discussions that you're going, that you want to that you discuss with startups. And the second part of this is clearly defining what that value proposition could be beyond just capital coming from a CVC. Because if I think, broadly speaking, and this is not true for all CVCs, but broadly speaking, especially a CVC that doesn't have capital set aside for a long period of time, and you're kind of asking for money off the balance sheet every year, that's very difficult to compete on, versus standalone VCs who have a lot more capital set aside exactly for this activity for a period of 10 years. They don't have to keep going back begging for money to make one investment. And so if a CVC's primary competitive, a differentiator is just that we can give you money, I think, broadly speaking, CVCs will lose. And so clearly defining what besides the capital they can provide these startups, what that is, I think that will set expectations for the startups. That will set a directive for your internal team to actually, kind of follow through on those discussions and promises. And at the end of the day, I think that's what happens with, post investment kind of portfolio management. I think that's the real value drive and value add that you can provide the startups and all the other investors on the cap table as well.
Absolutely. Thank you. This is awesome, right? So we actually covered lots of topics in maybe less than 20 minutes. Can you imagine talk about, every step from, deal sourcing all the way to post-deal management. So again, thank you, Anthony. This is a this is really great insights there. And obviously we both know there's much more there. It's a very nuanced, business. Reach out to us if you have any questions. Thanks again, Anthony.
Thanks, Xiao.
All right. Take care.